Clyde, would you agree with that? I mean, that means that Amar's saying he kind of believes OPEC's story of, yes, OPEC's cutting to support prices in the interim, but its forecasts are still bullish for the second half of the year, as is the IEA's. But then we have Goldman Sachs headline today saying they're revising their demand growth outlooks again downwards. So, we're really stuck in this yo-yo, aren't we, at the moment?
Yeah, it's actually quite an interesting market. If you actually look for the last few months, in fact, pretty much the whole year, oil's been in a sort of broad $70 to $90 range, if you're talking Brent, and spent more of the time around 75 than it has above 80. It briefly got up close to 90, almost got below 70, but didn't. So basically, you're looking at a fairly narrow range. Now, what has actually happened to keep it in that narrow range is basically OPEC Plus, and now lately the Saudis acting unilaterally, they've been working very hard to keep it above 70. So you'd argue that all this cutting of production, all that it has achieved is it's kept the price above 70. My own feeling is that if the world is heading towards a recession, and certainly the economic indicators that I like to watch, like purchasing managers indexes and things like that, certainly suggest that things are going to get worse before they get any better. Is $75 oil an appropriate level for a world economy that is slowing and likely heading into recession? I would argue probably not. So I think OPEC Plus is leaning against the wind. The big hope is that somehow we have a huge demand explosion in the second half. That's what the IEA is forecasting. It's what OPEC's forecasting. It's what Goldman and a bunch of other people are forecasting. And they're really basing that forecast on a strong recovery in China, India remaining pretty solid, and the rest of the world not having having a very shallow slowdown, or certainly avoiding the worst of a recession. Those are things that could happen. Would I think it's a central case right now? I'm not so optimistic. I think when you start to tighten monetary policy as much as it has been tightened globally, then you make a recession all the much more likely, and that is not going to be positive for oil. And I don't think China can ride to the rescue.
I mean, on the point of again, just sticking to OPEC, but more broadly, we have a bulletin on our bulletin, an article today saying that US crude exports could benefit from the additional cuts that OPEC keeps adding. Do you think that's the case? Do you see that dynamic changing? Are US exports going to be impacted by that, or OPEC? Is OPEC's demand security secure, if you like, into Asia and elsewhere?
Well, I think we can already see quite a few interesting things happening in this space. When you get quite a good idea of US exports to Asia quite far in advance because of the shipping time. So we already are looking at July US exports into Asia at a record high, something north of 2 million barrels a day. That's obviously being incentivized by WTI being slightly cheaper, but it also is basically the Middle East oils, the official selling prices, they've been actually raising them against the benchmarks rather than cutting them. And they've been taking output off the table as well. So Asian refiners are very happy to turn to US crude if they can, and if it's at a reasonable price. I think you also got to look at the Chinese. They are continuing to buy huge volumes of Russian crude. They've been upping, as far as we're aware, their purchases from Iran as well. And, there's even a little bit more Venezuelan oil flowing around. So they are looking very much for alternatives to those now relatively expensive to other grades of the Middle Eastern crudes from Saudi, from the Emirates, from the Kuwaitis, that sort of thing. So I think, yes, that's a positive. The other thing that you can look at is if OPEC Plus is successful in keeping oil prices above 75, they probably prefer them above 80. All that actually does is incentivize US production to continue at relatively high levels. I mean, it's at relatively high levels now. That's probably a hangover from the high prices we saw last year. It obviously works with a bit of a lag. But if prices remain, sort of above 75, 80, the US producers are going to say, well, we can continue to pump more. So that, in some ways, it does boost the sort of supply response from people outside of OPEC Plus. by keeping the price at a relatively high level. And one final thought on this is a demand side. I've followed what the Chinese actually physically do quite a lot. And it's quite clear that when they believe the price has risen too high or too quickly, they stop importing large amounts. They will still import a base amount. That's probably about 10 million barrels a day. But that sort of extra that they like to do, if prices are, they deem them to be reasonable, that kind of disappears. So the more successful OPEC is, the less likely the Chinese will actually meet their bullish demand forecasts. So China's bullish demand forecast is a function of price. If the price remains what the Chinese deem to be reasonable, and I would say that currently that would be around the 70, 75 mark, then the Chinese will continue to import. Their imports were strong in May. They might tail off a little bit in June, but they will continue to import. If the price goes back above 85, 90 bucks, I would imagine that the Chinese will cut back on their imports and dip into their stockpiles.
On that front of products, what's the latest with Chinese product exports, quotas there? What the indicators there that give us obviously how demand is doing domestically and how perhaps regional demand is doing?
Well, I mean, we did see a massive increase in their product exports in the first quarter. They're still fairly high, but they are starting to taper down. What has actually happened is the refiners have basically used up most of their quotas. Yes, there are some new quotas about, but they're not the massive volumes. So I would expect to see Chinese product exports continue at a reasonable clip, but certainly nothing like the almost 60% jump that we had in the first quarter. It was a very simple economic win for the Chinese to stimulate the economy. They wanted growth, they wanted it fast, buying in crude, exporting products, making a nice profit, especially if you were exporting Russian crude as products, was an easy win for them. They're not that interested in continuing that. They also wanted to make sure they had enough domestic fuel stockpiled and to meet their summer demand. We haven't actually seen a huge amount of diesel demand. So if there are product exports from China, it's most likely to be in the diesel. We have seen the margin for diesel fall quite sharply in Asia. So that's kind of the dynamic we have at the moment. But it's one of these things that can change very quickly. If the Chinese decide they want more stimulus in their economy, or they see an opportunity to make money, then they'll be quite happy to import crude and export products. But at the moment, I expect that to taper off, which is another reason I'm not so super bullish on Chinese oil imports, because I expect that they'll be exporting less product.
In the context of the US dollar comments Alma just made, but give us a bit of your view on Asia, other commodities, commodities outlook, demand for Asian commodities, in terms of what those are showing us about industrial demand, etc., beyond energy, if you like, products.
Well, it's quite interesting. The one I always look at most often is iron ore. And, again, that's a very China-dominant trade. It buys 70% of seaborne iron ore. We're still seeing fairly solid volumes, but we're starting to see a bit of price pressure. It's one of those weird things that bad economic news sometimes actually causes iron ore to rally, because everybody believes Beijing's going to go and stimulate the economy more than it already is. So I think that kind of brings us down to that sort of thing of China has had a sluggish recovery, an uneven recovery from its after it ended its COVID lockdowns. And that's sort of still continuing. There's still optimism out there that they will, manage to stimulate the economy and get things going again. I would be very cautious about betting against China. They have a quite good track record of doing this, but there's still other things that is beyond their control. So like their manufacturing exports, if the world does have a recession. So for me, it's all very finely balanced at the moment. We're starting to see some areas of pressure, iron ore, copper, those are not looking that good. But they're certainly not, indicating a major crash ahead or anything bad like that. It's just a sort of bouncing along in this kind of uneven period of lingering uncertainty.